oil flirting with triple digits, bond yields grinding higher, and an AI spending boom funded by debt are all pulling portfolios in different directions right now. This is vTalkInsight, Allocator's Lens Daily for July 27th, 2026, where we connect these forces across equities, rates, credit, foreign exchange, and commodities. In equities, the core tension is between still solid earnings and a growing squeeze from higher yields, energy costs, and AI-driven capital spending. Headline indices remain only 2 to 3% below their peaks. Yet the market has now logged back-to-back weekly losses, revealing how fragile that resilience has become. Recent price action shows that weakness is concentrated rather than universal. The S&P 500 finished a recent session essentially flat, even though most sectors gained, because large-cap technology pulled the index down. Real estate led with more than a 2% advance, while information technology was the only sector in the red, and capital is rotating toward energy, industrials, financials, and healthcare rather than exiting equities entirely. The most crowded AI and semiconductor names are bearing the brunt of this adjustment. Chip stocks have cooled after an 80% rally over the past year. AI-related shares are down roughly 15 to 20%, and even strong earnings beats from companies like Intel and leading cloud software names have not prevented broad sector drawdowns. Fundamentals inside AI remain mixed rather than outright negative. Intel, for example, has guided to better-than-expected revenue on strong data center demand and is lifting capital spending, while European tech has enjoyed a relief rally on robust cloud bookings. At the same time, investors are questioning whether the massive build-out of data centers will earn its cost of capital, especially as cheaper AI models could pressure margins and several megacap names are cutting buybacks to fund Capex. Valuation is where the equity story tightens for allocators. The technology sector's price-to-earnings multiple has already fallen from the low 30s to the low 20s, and its premium to the broader market has shrunk from roughly 45% to about 10%, yet rising real yields keep the pressure on, with 10-year Treasury rates around 4.7% and discussions about a possible move toward 5% that could push index multiples several turns lower. The macro environment still offers support. Earnings expectations for the S&P 500 this year have been revised up sharply. Economic data point to a soft landing backdrop rather than a growth scare, and even with oil around $100, consumer demand has not cracked. However, around 85% of companies are beating estimates, and many stocks are still trading down after results, which suggests that a near-perfect scenario is already embedded in prices. Current base case downside for equities is seen in the high single digits, but the more worrying tale comes from the intersection of AI and credit. A significant share of the AI build-out is debt-financed, and if that investment cycle peaks or returns disappoint, the resulting stress in funding markets could drive equity losses well beyond that 7 to 8% range. As we turn to rates, that link between higher-for-longer yields and equity downside becomes even clearer. In rates, the dominant theme is a global reset higher in bond yields driven by sticky inflation, widening fiscal deficits, and capital-intensive AI investment. U.S. 10-year yields are hovering in the high 4% range. The 30-year has traded above 5%, and Europe and Japan have also seen yields climb as investors reassess the inflation and supply outlook. The Federal Reserve sits at the center of this repricing. Market pricing now leans toward 2 additional hikes by early next year, while many economist surveys still expect no further tightening and even a cut in a couple of years, and front-end treasuries yield more than the current policy rate, underscoring how much uncertainty the upcoming meeting carries. That uncertainty is rooted in a broad set of inflation pressures. Energy prices near $100 oil, new tariffs on a wide set of trading partners that are likely to lift import costs, and AI-related demand for infrastructure all feed into concerns that inflation could stay above target, keeping real rates elevated for longer. At the same time, policy divergence is becoming more pronounced across regions. The European Central Bank is expected to deliver perhaps one more hike as insurance against the energy shock before turning toward cuts later this year. While in Japan, surging government bond yields suggest markets believe the central bank is behind the curve, adding another dimension to global rate volatility. Term premia are rebuilding as investors focus on heavy treasury supply. including a closely watched quarterly refunding, and on the longer-run cost of funding AI and fiscal deficits. With bond equity correlations now positive and yields increasingly driving both valuation and credit spreads, the rates market is once again central to cross-asset risk, making the Fed's communication, energy prices, and refunding details critical watch points for allocators. That rising yield backdrop feeds directly into how credit markets are repricing risk. Credit has transitioned from a straightforward carry story to one where early signs of stress are emerging, particularly around AI and technology issuers. Spreads remain tight by historical standards, but they have started to widen, signaling greater risk aversion even as all-in yields stay attractive in nominal terms. The central pressure point is the way the AI infrastructure boom is being financed. Tech companies have issued more than $200 billion of debt this year to fund data centers, and recent deals linked to large AI projects have come with noticeably higher coupons, including one major U.S. data center financing that priced around 7.5%, reflecting investor demands for more compensation. There are also signs of demand fatigue. Investment-grade bonds funding AI data center projects are no longer enjoying the same oversubscription as earlier in the cycle, and investors are increasingly uneasy about concentration risk as a growing share of corporate bond indices tilts toward a handful of large tech and AI names. That raises the stakes of any disappointment in AI returns. If earnings do not keep pace with Capex and credit markets continue to demand higher spreads, the AI credit nexus could become a transmission channel for broader financial stress, amplifying equity downside beyond the current base case scenarios and challenging the notion that spreads can stay tight simply because cash balances are high. For multi-asset allocators, credit spreads around the big AI issuers have effectively become a barometer of broader risk appetite. Widening in those sectors alongside higher real yields is a clear signal that markets are becoming more selective about leverage and capital intensity, with implications for equities, private credit, and even currencies that are sensitive to global funding conditions. Those funding and policy divergences show up clearly in foreign exchange. In foreign exchange, the combination of higher U.S. yields and geopolitical risk is lending support to the dollar. With Treasury rates elevated across the curve and volatility edging up, the greenback continues to benefit from both its rate advantage and its role as the primary safe haven asset. Other major currencies are being pulled in different directions. The euro is finding some support from improving business surveys and the prospect of only limited further tightening by the European Central Bank, while the yen faces crosswinds as Japanese yields rise but still lag global peers, and Switzerland continues to attract wealth flows from clients seeking stability amid Middle Eastern tensions and shifting regulatory landscapes. FX is effectively acting as a release valve for both energy and policy shocks. Currencies of energy importers are sensitive to the latest headlines from oil shipping lanes and gas markets, and rate differentials driven by how central banks respond to those shocks will be a key driver of cross-border capital flows over the coming months, linking directly into equity and bond performance. Nowhere is that more evident than in commodities themselves. Commodities, and especially energy, remain the main transmission channel from geopolitics into inflation and asset prices. Brent crude has recently broken into triple digits after surging more than 30% this month, driven by disruptions around the Strait of Hormuz and Bab el-Mandeb, and the risk that any new attacks on shipping could provoke a broader military response. What makes this spike more concerning is the lack of buffers in the system. Global oil inventories are well below prior disruption episodes. The U.S. Strategic Reserve has been drawn down by over 100 million barrels, and refining capacity is running near the mid-90s in percentage terms, while export restrictions from key suppliers of refined products have tightened markets for diesel and jet fuel. Natural gas markets, particularly in Europe, add another layer of risk. Supply is expected to remain constrained for years, with Europe competing against major Asian buyers for liquefied natural gas cargoes as all sides build inventories ahead of winter, leaving little room for error if further disruptions occur. Agricultural prices tell a more nuanced story. Wheat has jumped nearly 20% this month alongside the energy move, feeding stagflation concerns. Yet broader food inflation has eased back toward long-term averages, helped by lower prices in items like eggs and berries, and by declining U.S. gas and fertilizer costs that support domestic agricultural input margins. For allocators, the key point is that today's energy complex amplifies inflation risk, even if headline data stay volatile month to month. Oil near $100, tight gas and refined product markets, and low inventories all raise the odds that central banks feel compelled either to keep policy tight for longer or to accept higher inflation, both of which would reinforce the higher yield, higher volatility environment we see across assets. Putting it all together, we have equity markets still close to their highs, but increasingly dependent on a narrow earnings story. Rates undergoing a global reset as inflation and AI Capex lift real yields. Credit starting to question debt-funded growth. Currencies reflecting policy divergence and safe haven demand. And commodities exporting an energy shock into every other asset class. The balance of risks is shifting toward a world where higher for longer yields, volatile oil, and more discriminating capital markets coexist with an economy that is yet to show clear signs of slowdown, making cross-asset linkages more important than ever to monitor. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.